Chart of Accounts, the financial blueprint behind every business. Welcome to Learning Bites. What do Apple, Microsoft, Unilever, and your local grocery store all have in common? Despite their massive differences, every business relies on a critical financial framework. A system so important that without it, financial reporting would become chaos. That system is called the Chart of Accounts. But what exactly is a chart of accounts? Why do accountants spend so much time designing it? And how does it help businesses make billion-dollar decisions? Today, we'll explore the financial blueprint that sits behind every successful organization. Chapter Ek, what is a chart of accounts? Imagine constructing a skyscraper without a blueprint. Electricians would place wires randomly. Builders would guess where walls belong. Materials would be impossible to track. The project would quickly become a disaster. In finance, the chart of accounts serves as that blueprint. A chart of accounts, often called CA, is a structured list of all financial accounts used by an organization to record business transactions. Every payment, every sale, every expense, every asset, and every liability eventually finds its place inside the chart of accounts. Without a well-designed CA, companies would struggle to generate accurate financial reports, monitor performance, or complete with accounting standards. Chart of Accounts Financial Blueprint. Chapter Duty. Why does a business need a every day? A business generates hundreds or even thousands of transactions. Customers make payments. Suppliers submit invoices. Employees receive salaries. Banks charge fees. Governments collect tax. Without organization, financial information becomes useless. The chart of accounts brings structure to this complexity. It allows businesses to track performance, monitor costs, prepare financial statements, meet regulatory requirements, support management decision-making, and maintain transparency. Think of it like a giant filing cabinet where every financial transaction has a designated drawer. Key message: good accounting begins with good organization. Chapter 10. The 5 main account categories. A standard chart of accounts is generally divided into 5 major categories. Let's examine each one. Assets represent resources owned by the company. Examples include cash, bank balances, accounts receivable, inventory, machinery, vehicles, buildings. Assets generate future economic value and form the foundation of business operations. Example: if a company has $1 million in cash and inventory, those balances are recorded under asset accounts. Liabilities represent obligations owed to outsiders. Examples include bank loans, accounts payable, tax payable, accrued expenses, lease obligations. Liabilities tell us how much a business owes. Equity represents the owner's interest in the business. It includes share capital, retained earnings, additional paid-in capital, owner contributions. Equity can be thought of as what remains after liabilities are deducted from assets. Revenue represents money earned from business activities. Examples include product sales, service income, consulting fees, rental income, interest income. Revenue shows how businesses generate value. Expenses represent the costs required to operate the business. Examples include salaries, rent, utilities, marketing, travel expenses, office supplies, insurance. Expenses reduce profit but are necessary to generate revenue. Chapter 4, Numbering System. Most organizations don't simply list account names. They create account numbers. These codes make financial information easier to manage and analyze. For example, 1000 series assets, 2000 series liabilities, 3000 series equity, 4000 series revenue, 5000 series expenses. A company may assign 1010 cash, 1020 bank account, 1200 accounts receivable, 2010 accounts payable, 4010 product sales, 5010 salaries expense. This structure creates consistency throughout the accounting system. Chapter 5, How connects to financial statements. Every account eventually feeds into financial statements. Asset, liability, and equity accounts contribute to the balance sheet. Revenue and expense accounts contribute to the income statement. Without a chart of accounts, preparing these reports would require manually sorting thousands of transactions. Instead, accounting software automatically organizes transactions according to the cost structure. This allows management to quickly answer critical questions. How much cash do we have? What are our expenses? Are we profitable? How much do customers owe us? Chapter 3, The Role of Code in ERP Systems. In modern organizations, the chart of accounts is integrated directly into ERP systems. Whether a company uses SAP, Oracle, Microsoft Dynamics, Sage, QuickBooks, or other accounting software, the chart of accounts serves as the backbone of financial recording. Every purchase order, every journal entry, every invoice, every payroll transaction ultimately maps to a specific account code. This ensures consistency across departments and business units. Chapter Shot, Common mistakes. Not all charts of accounts are well designed. Some organizations create too many accounts. Others create too few. Common mistakes include duplicate accounts, inconsistent naming conventions, poor account numbering, lack of standardization across departments, excessive complexity. These issues create reporting challenges and reduce decision-making quality. A good chart of accounts should be detailed enough for analysis, but simple enough to maintain. The chart of accounts may not be the most glamorous part of accounting. Yet it is only the most important. It transforms financial chaos into order. It enables transparency, supports decision-making, improves compliance, and provides the foundation for reliable financial reporting. Whether you're running a small business, managing a multinational corporation, or starting a career in accounting, understanding the chart of accounts is essential. Because behind every successful financial system lies a well-designed structure. And that structure begins with the chart of accounts. Like, share, subscribe. Understanding money. Building business.